All right, so you know how sometimes the stock market can seem like this kind of like closed off thing?
Yeah,
Like you need some sort of special pass or some
right.
like Wall Street address to even get in there.
Hmm.
But what if we kind of reframed it a bit? And what if it was actually like one of the best tools that you have,
Yeah,
especially, I mean, you as a young adult, to build some really serious financial freedom?
absolutely. And I think that you hit the nail on the head when you talk about it feeling kind of exclusive. The flashing numbers, the jargon, it can be a bit of a barrier to entry. But really, at the end of the day, the stock market is just a way for everyday people like ourselves to own a piece of these really successful companies and to grow our wealth over time. So, our goal today is to kind of break down some of those barriers and to give you guys the knowledge you need to get started.
Yeah, because, when you're thinking about those big goals in your life, like getting that down payment for a house, or maybe starting that side hustle you've always wanted to do, or even, just picturing a future where you have more choices about when and how you work, just, taking your savings and putting it in a regular bank account doesn't really get you there as quickly as you want.
No, not at all. And the returns on those traditional savings accounts, they're pretty low, and that's where the stock market comes in. It's got the potential for way higher growth over the long term, and this is where you, the listener, being a young adult, have this huge advantage. That's time.
Time.
Time is the secret weapon when it comes to investing. The sooner you get started, the more you can take advantage of this thing called compounding. Imagine that your initial investments, they earn returns. But then those returns, they start earning their own returns. It's like returns on returns, and over time, like over decades, this can really snowball and lead to like serious, serious growth.
Yeah, that's the snowball effect.
It is. It's powerful.
All right, so let's take a step back here.
Sure.
What exactly is the stock market?
In the most basic terms, the stock market is this marketplace where you can buy and sell pieces of companies. So imagine a company, they decide to offer up a portion of themselves to the public to raise some money. These little pieces of ownership, these are shares or stocks.
Okay, so I'm buying like a slice of the pie.
Exactly. And when you buy a share, you become a part owner. You're a part owner of that company.
That's pretty cool.
It is. And all this buying and selling happens in specific places, like the New York Stock Exchange.
Right, the NYSE, we hear that all the time.
Exactly. The NYSE and the NASDAQ, these are the main platforms where these transactions happen. There are these organized marketplaces where buyers and sellers can come together. And to actually get into this market and start buying those shares, the first thing you need to do is open what's called a brokerage account.
Yeah, and it's kind of amazing how easy that has become these days. It's not like the old days where you had to call some guy in a suit
No, you don't need a special phone anymore.
to place your order or something.
Yeah. No, not at all. These days we have so many user-friendly online platforms. You've got Robinhood, E-Trade, TD Ameritrade, and they've really opened up investing to everyone. The interfaces are so intuitive and easy to use. And what's maybe even more important for someone just starting out, they've got tons of educational resources to help you learn the ropes.
Okay, so now I've got my account set up. I'm looking at the screen. I see all these different options. What types of stocks are out there?
Generally speaking, we talk about two main types of stock: common stock and preferred stock. Common stock is the most common one. It's what people usually think of when they think of stock. These shares usually give you the shareholder voting rights on company decisions, and they also have the potential to pay out dividends.
Right, dividends. So that's like getting a little piece of the company's profit.
Yeah, exactly. It's like a share of the profits distributed back to the owners.
Okay, and preferred stock is a little different.
It is preferred stockholders. They usually don't get to vote, but they
Yeah.
get this fixed dividend payment on a regular schedule. So you might have more predictable income with preferred stock, but you don't really get to have a say in how the company is run, no matter which type of stock you're interested in. One of the most important things to remember is diversification.
Right, diversification. So that's basically just not putting all your eggs in one basket.
It's all about spreading your money across different investments to reduce your risk because let's face it, some investments are going to do better than others.
Exactly.
So in the stock market, this means investing in different types of companies from various sectors of the economy. So you might have some technology companies, some healthcare companies, some companies that make everyday consumer goods, a real mix.
So that way, if one part of the market is having a rough time, my whole portfolio isn't going down with it.
That's the idea, and a really easy way to diversify, especially when you're just starting out, is with something called ETFs.
Yeah.
Yeah, that stands for exchange-traded funds and mutual funds. These are basically like baskets of stocks or other investments. They're managed by professionals, and they pool money from lots of investors. to buy a whole bunch of different things. It's like buying a tiny piece of the whole market or a specific part of it with just one investment. So you could invest in an ETF that tracks the S&P 500, for example, and that would give you exposure to the 500 largest companies in the U.S.
Oh, cool. So now we're getting a sense of what the market is and how to get in there and why it's smart to spread our bets around a bit. But let's talk about the elephant in the room here. The market's always going up and down.
Yeah, the volatility.
It can be a little nerve-wracking to see those numbers constantly changing.
I totally get that. That's market volatility. And it's just part of investing in stocks. Prices are constantly reacting to all sorts of things, how well companies are doing, the overall health of the economy, even global events like wars or elections. It's important to understand that these ups and downs are normal. It's just how the market works.
So how do I not freak out and sell everything when things start to go south?
The key is to have a long-term perspective. Don't get caught up in the day-to-day noise and the little price swings. Focus on the fundamentals.
Fundamentals?
Yeah, look at the underlying strength of the companies you've invested in. Are they profitable? Are they growing? Do they have good leadership?
And this makes me think of Warren Buffett.
Ah, yes, the Oracle of Omaha.
With his famous buy and hold strategy.
Exactly. Warren Buffett is all about finding companies that he believes are undervalued, meaning their stock price is lower than what he thinks they're really worth based on their fundamentals, and then he holds on to those stocks for the long haul, no matter what the market does in the short term. He's all about patience and doing your research.
So it's about trusting your picks and not getting spooked by all the day-to-day drama.
Right, and remember, everyone's situation is different. What works for one person might not work for another.
So how do I figure out what kind of approach is right for me?
That's a great question, and the first step is to define your financial goals. What are you hoping to achieve with your investments? Are you saving for retirement, which could be decades away? Or are you trying to buy a house in the next few years? Maybe you want to start a business. Your goals and your time horizon will shape your investment choices and how much risk you're willing to take.
Yeah, if I need the money soon, I probably don't want to put it all in risky stocks.
Exactly, and that brings us to risk tolerance. How comfortable are you with the idea that your investments could lose value in the short term? Can you stomach the ups and downs knowing that it's a long game? Or would that keep you up at night? Understanding your own risk tolerance is crucial. It helps you choose investments that align with your personality.
So it's not just about chasing the highest returns, it's about peace of mind too.
Absolutely. And remember, both your financial goals and your risk tolerance can change over time. As you get closer to retirement, you might want to shift towards more conservative investments. That's why it's smart to check in with your portfolio regularly. And maybe adjust how you've allocated your money, depending on what's going on in your life and in the market.
Okay, that makes sense. So we've talked about Warren Buffett, but are there other investors whose philosophies are worth learning about?
Definitely another legend is Peter Lynch. He managed this incredibly successful mutual fund called the Fidelity Magellan Fund, and his philosophy was all about investing in what you know. He said, look around at the companies and brands you use every day. Do you like their products? Do they seem like they have a good business model? Those could be good investments. He encouraged people to really understand the businesses they were investing in.
So if Buffett is all about finding those hidden gems with strong fundamentals, Lynch is saying look around you for inspiration.
That's a good way to put it.
Okay, now let's switch gears a little bit. The stock market hasn't always been the smooth ride upwards. We've had crashes, bubbles, all sorts of drama.
Oh, yeah, there's been plenty of drama.
Can you walk us through some of the major moments in stock market history?
Absolutely. It's important to understand that market ups and downs, even big downturns, they're just part of the history of the market. Like the Great Depression back in 1929.
The Great Depression.
That was a huge market collapse. It had a devastating impact on the entire world. And then in the late 90s, we had the dot-com bubble.
The dot-com bubble.
Yeah, there was all this crazy speculation in internet companies, many of which didn't even have any real profits. It led to this massive surge in stock prices and then this dramatic crash. And more recently, we had the 2008 financial crisis, which was triggered by problems in the housing market. But it sent shockwaves through the entire financial system, including the stock market.
So what can we learn from these events?
Well, for one, they show that the market moves in cycles. You're always going to have periods of growth followed by corrections or even bear markets. And they really highlight the importance of diversification. If you're not too concentrated in one area, you can weather those storms a bit better.
Right. It's like that old saying, don't put all your eggs in one basket.
Exactly.
Okay, so let's talk about some of the more surprising things about the stock market.
Sure.
Any fun facts that might surprise our listeners?
Well, did you know that the New York Stock Exchange, the one we talked about earlier, it was founded all the way back in 1792.
Wow, 1792, that's older than America.
I know, right? And what's even more amazing is that it's still the largest stock exchange in the world, based on the total value of all the companies listed there. That's called market capitalization. It's basically the total value of a company's outstanding shares.
So that's a lot of money changing hands on a platform that's been around for centuries.
It's a testament to the enduring power of the stock market.
Okay, you got another one for me?
I do. How about this? After the 2008 financial crisis, the stock market went on the longest bull market in history. It started in March 2009 and lasted for over a decade. It just shows you how resilient the market can be and how it can keep growing even after really tough times.
That's pretty inspiring.
It is.
All right, as we wrap things up here, what are the big takeaways from our deep dive today?
The main thing to remember is that the stock market is a powerful tool, especially for young adults, because of that compounding effect we talked about. The earlier you start, the better. But it's important to understand the basics, what the market is, how stocks and shares work, and why diversification is so crucial. You also need to set clear financial goals and be honest with yourself about your risk tolerance. And finally, take a page from the books of investors like Warren Buffett and Peter Lynch. They've shown that patience and a long-term perspective are key.
It's about taking those first steps and starting to build that financial future you want.
Exactly. And don't be afraid to keep learning. Stay curious about the market and the economy. And be ready to adapt your strategy as things change.
So here's a final thought for our listeners. Take some time to think about your own financial goals and how what we talked about today can help you achieve them. Maybe do some more research on different types of investments or dig deeper into the philosophies of Buffett and Lynch. It's all about taking that next step. Thanks for joining us for this deep dive.
Thanks, everyone.
We'll see you next time.
See you later.
Bye.